The next 29 days could change your life. With the market teetering on the edge, war escalating, tariffs looming, and the Fed looking like a deer in the headlights, investors are bracing for a correction where stocks drop 5 or 10%. But while most will panic, earnings season is just 29 days away, and the next few weeks will be your opportunity at life-changing money. Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. This week with a special step-by-step for the coming stock market sell-off. Not a crash, but your chance to get stocks at discount prices. Stick around and I'll also share important updates to shares of GameStop and Super Microcomputer. Onto that main topic though, and the big market-shaking news Friday was the 200 Israeli fighter jets striking nuclear and military targets deep inside Iran, and Israel reporting a 14-day operation to continue. That news sent the price of oil up as much as 11% and stocks into a tailspin. But the important question is that escalation. Iran has retaliated with its own missiles, but has tempered its reactions in the past to avoid an all-out war. And that's because against continued sanctions, chronic and power water shortages, and inflation, Iran just can't afford a protracted war, with the economy set to grow at just 1.5% pace this year. Russia has cut off much of its longtime aid to focus on its own war with Ukraine. Israel knows this, so it's taking the opportunity for unilateral strikes against nuclear and military targets. But nobody wants a regional war here, and this isn't the big inflection point to that stock market crash. More importantly, though, is the coming deadline to the 90-day tariff pause for every country except China. The pause on higher rates for 130 countries expires July 9th, with some rates threatened to return as high as 48%. But the administration is already signaling an extension for some, with the market expecting overall tariffs to remain in the range of 10 to 25% for imports. That pause and de-escalation with China helped send consumer sentiment up for the first time this year. And so far, tariffs haven't driven higher prices yet. But against this backdrop, the market is undeniably expensive and looking for a reason to sell off some of that amazing 20% rebound since April that has pushed stocks within 1.5% of their all-time high. Stocks are back to a price of 26 times reported earnings, not back to the nosebleed valuations that started the year, but still 18% more expensive than the longer-term 10-year average PE ratio. And it looks even worse on an earnings yield basis, the percentage return you get in earnings for the price on the market, down to under 2% for the first time since before the 2008 crash. Now understand, stocks do not fall just because prices get expensive or investors get a little nervous. There always has to be a catalyst, more often than not just an excuse for investors to start taking profits and then panic selling as the market drops. While we're not likely to see stocks crash, this does have all the clues of a typical market correction, where stocks fall 5 or 10%, just that brief dip that happens nearly every single year. Over the last 20 years, including two of the biggest market crashes ever, 13 of the years saw a dip of 10% or less before recovery. And folks, that's where we find ourselves, heading into one of those normal 5 to 10% corrections, but with more than $7 trillion cash on the sidelines. And understand, that's just the amount in money market accounts earning 5%. Americans also have another $34.5 trillion in homeowners' equity after more than a decade of exploding home prices that has taken the household debt-to-assets ratio to its lowest in 50 years. With all this financial firepower and a strong buy-the-dip mentality still supporting stocks, that correction is going to be one of the best opportunities you're going to see all year. But just as stocks don't fall without a catalyst, they're going to need one to break out of that correction momentum as well. And don't think we're going to get any help from the Fed on this. Chair Powell and the central bank meets for its rate-setting decision this Wednesday, but using the CME FedWatch rate tool, which uses rate futures to predict the Fed decisions, we see a 97% probability that the Fed is going to keep interest rates steady, and it doesn't get much better from there, with market odds of 77% that the Fed keeps rates on hold in its July meeting as well. In fact, because the economy is holding up, the market doesn't see the Fed cutting interest rates until September at the earliest. That means the best bet we have for a catalyst to send stocks higher again is going to be the second quarter earnings, which are going to start July 14th, roughly 29 days from now when the big banks kick off that earnings season. This is going to be an extremely important earnings season because we're going to start to see the effects of tariffs on profits, and companies are going to update their full-year outlooks. In data by FactSet, which surveys Wall Street expectations for earnings, forecasts are for just 4.9% profit growth on stocks in the S&P 500 index, those 500 largest U.S. companies. And comparing that to where estimates were just 2 months ago, with forecasts then for 9.3% profit growth, it shows you how worried the market is that earnings are going to be very bad. In fact, companies in 5 of the 11 stock sectors are expected to see earnings fall versus the same quarter last year. Given the quick pause on tariffs, the fact that inflation hasn't been an issue yet, and that the jobs market has held up really well, I think there is a good chance that earnings are much better than expected and break us out of any correction level funk that we're in by that time. So I want to give you some ways to invest, levels I'm watching, and some stocks to buy. As always, I wouldn't recommend trying to time this market correction, but instead set buy-in points along the way to take advantage of that dip. With the S&P 500 around 59.80 on Friday's sell-off, I would look to 58.33 for a confirmation that we're going into that correction territory. That would take the market down 3.5% from its peak last week, and that's when we really start to see those scared investors start pulling out. So if we hit that point, we're probably heading lower and just hold on. If that happens, I'd wait till we get around to 5,700 on the S&P 500, which would be about 5.7% lower. It's not to say that the correction would be over by that time, but here you want to start picking up those lower prices, especially in your favorite growth stocks, because remember, those are going to be selling off even harder. I highlighted Symbotic, ticker SYM, as my top stock on Friday and pointed out that when the market crashed 20% in that April tariff tantrum, shares of Symbotic got crushed 50%. So be ready for these higher risk, higher return stocks to fall even faster. The reason I'm using this S&P 500 index for buying levels is we can use this one index to plan out when we're going to buy rather than do it for each and every stock. If we continue to head lower beyond 5,700 though, I'd be buying in again around 55.60, which would be about 8% down, and again at 54.10, which would be just over a 10% correction. Nation, understand, this isn't about trying to time the market. It's about taking advantage of those lower prices, but not waiting too long and missing out on your opportunity. It's about having that plan for when you're going to buy, so you're not pulling your hair out watching the market every day and wondering if you should buy now or now or now. It's a low stress way to make sure that you take this opportunity to buy stocks at those lower prices that we're going to get and before they head higher again. As for the stocks to buy during this period, there are two approaches, but I think you should take a little bit from each. First is you can load up now on some of the stocks that should be relatively safe from the sell-off, and given that Middle East tension is likely to last at least a few weeks into earnings season, you're going to find the best safety in oil stocks and defense companies. The Energy Sector Spider ETF, ticker XLE, which holds the 23 largest energy companies, jumped 1.6% on Friday's news and pays you a 3.5% dividend while you wait. And using the Sector Spider tracker, you can see some of the individual stocks in that group with channel favorites like Diamondback Energy, ticker FANG, Devon Energy, DVN, and Chevron, ticker CVX, which now pays a 4.7% dividend. On that defense side, check out the Global X Defense Tech ETF, ticker SHLD, up a surprising 58% this year and 1.8% on Friday alone. My favorite use of this ETF, though, is going to be going through the website, finding holdings in the menu, and then mining through the 42 stocks held by the fund to find the very best to buy. Here you've got tech growth names like Palantir, along with old school defense in Lockheed Martin and L3 Harris. Stocks in those two groups, oil and defense, are likely to hold up and help you keep your sanity as the market looks for a bottom, but do not neglect the growth stocks that we love so much here on the channel. It's here where if the market does correct that 10%, you're going to be getting the best deals with some of these stocks crashing 20 or 30% and more. And yes, it is going to be painful, and you are going to be totally freaking out at times. But nation, money is not made when the stock market is up. It is made when you buy while the market is down. I'm going to link to a few videos in the description for growth stocks I'm going to be buying during the dip. A great place to start would be Friday's video, where I highlighted SoundHound AI, quantum computing, SMCI, and Symbotic as stocks with 10, even 20 times your money potential. But also check out last Tuesday's ranking of the best deals in AI stocks, which besides highlighting SMCI and Symbotic again, also uncovered some of the already cheap deals in stocks like Micron, HPE, and Upstart Holdings. Now looking at the stocks I'm watching this week, GameStop, ticker GME, plunged as much as 23% last week after announcing it would issue $2.25 billion in convertible notes, non-interest debt due in 2032. And we don't usually talk about these short-term trades here on the channel, but researching this, it's this kind of high-confidence trade that is worth the risk. Looking back through the company's news, we see the exact same thing in March when GameStop announced a $1.3 billion debt offer, sending the shares down by as much as 25% on that day, but then to rally back 20% over the next month. GameStop is still very popular with retail investors, the second highest mentioned stock on Reddit, with nearly 3,800 mentions in a single week. And hell, when a stock jumps 2,000% in a matter of days, there will always be people watching and buying the dips, supporting that company. Shares are now near their one-year low, and the company could be planning something big. GameStop is still cash flow positive, and with $6.4 billion cash on the balance sheet, it doesn't need another $2.25 billion. In fact, the announcement does say that the funds will be used for investment, so I like the upside back to $30 on this, and any news or just general buy the dip bounce. Lululemon Athletica, ticker LULU, also took a giant shit on investors, down 25% last week when the company cut its profit forecast for the year and announced it would also write down assets due to the tariffs. The sportswear maker now expects current year earnings around $14.68 a share versus a midpoint of $15.05 previously, but still expects sales up 6% to $11.2 billion. That crash took shares down to a 5-year low, but could also be a buying opportunity. Lululemon shifted most of its production to Southeast Asia, where it now sources 86% of its production, so it doesn't quite have to contend with as much from that 30% rate on Chinese goods. But the fear over Vietnam tariffs is crushing the entire apparel industry. Valuation here has dropped to 2.8 times sales and under 17 on a price-to-earnings basis, both of which are about 27% below the average valuation it's traded at over the last year. And the company is still strongly cash flow positive and with $1.3 billion balance sheet cash, so no real existential risk here, and I like the shares at least back up to $300 each. And nation AI infrastructure stocks got more good news last week, though the market hasn't caught on yet. Shares of Oracle, ticker ORCL, jumped when it easily beat earnings estimates, reporting $15.9 billion in revenue and $1.70 per share, as well as raising the full-year revenue forecast on strong demand for AI cloud services. And while I did highlight Oracle as a buy late March when it hit $140 a share, it isn't here that the news took me. Buried deep in that news was the company's new capital spending forecast of $25 billion, well above the consensus estimate for $20 billion, and CEO Katz said even that might be underestimated. This is yet another increase in that data center spending theme, and while Oracle was up 19% on the news, Wall Street didn't make the connection with AI infrastructure plays. We saw shares of Broadcom, ticker AVGO, and Supermicro, SMCI, were flat on the week, while Arista Networks was down almost 5%. But these are the very companies that are going to see revenue spike as more data centers go up. There are others in that data center build-out theme. I also like Hewlett-Packard Enterprise, ticker HPE, but it's in those three names, AVGO, SMCI, and ANET, that I'm going to be buying the most. Giving you the bigger picture here with the Sector Spiders sector tracker. 5 of the 11 stock sectors closed higher last week with some surprising upside that shows there is still a place to make money in any market. Energy stocks were the obvious winner on the 13% surge in oil, but healthcare stocks also gained 1.3% and real estate finished in the green. Even tech stocks here managed to close positive on strong gains in heavyweights like Oracle and Palantir. Last week's bump takes the energy sector back into the green for the year, and it's likely to continue to do well at least in the next few weeks as the price of oil brings that cash flow to these names. U.S. shale drillers like Diamondback Energy and Devon Energy are the best positioned to take advantage of this upswing, though I also like Chevron, CVX, on its low-cost production. Check out the links in the description for the stocks I'm going to be buying on this dip and take advantage of this opportunity coming. Or click on the video to the right for the one stock that will make you a millionaire. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.